Hello, this is Joe Pryor, the virtual real estate team in Oklahoma City. And, I want to talk about the interest rate issue that we have right now. And I've said this now in multiple videos that I've just been doing about how rates have gone up so much in less than 90 days. I remember a webinar that I had on December 5th for investors. And I was talking about a rate that is now 1 3/8 points higher for 20 or 25% down. And also that in some cases, we're having even a hard time to getting what's called a par rate, where you don't have to pay any points, any extra money in order to get a 20% down. And that's been a problem. And we think there's a possibility we may see another interest rate increase from the Fed this month. We're not sure, haven't met yet, but it's kind of 50-50 at this point. So here's the thing. If you do put 25% down on a Fannie Mae mortgage, either as an owner-occupant, but as an investor is what I'm really talking about, you're going to get a lower interest rate. And the reason why I'm asking you to think about 25% down is also the fact that Fannie will only let you have 4 total mortgages without mortgage insurance at 20% down. And that's mortgages of any kind: your first home, your second home, your investment property, 5th through 10 per person, and that's your max. Fannie Mae loans, best interest rates, 30-year fixed, is 10, but they're all 25%. So the other issue right now is Oklahoma City is changing. There's a lot more appreciation, but because of the rising prices of housing that we've seen everywhere throughout the United States, it is a shortage, supply and demand issue, not just in Oklahoma City and Tulsa, but just anywhere that's a good market, that it's causing prices to rise. And we know that material costs are going up. We know there's a labor shortage. All these things are increasing prices. So you take that going up, you take interest rates going up 1 3/8, maybe 1.5 by the end of this month. And then what we have is a situation where Oklahoma City, in my 33 years of selling investment real estate, has always been cash flow, cash flow, cash flow, high cash flow, pretty low appreciation. Now that's changing. And I'm going to deal with this in the video just right after this, about how we're making these adjustments in terms of looking at our numbers. But I want you to start thinking about the fact that I'm putting 25% down, because this is going to give you the cash flow that you want. And there may be another reason for this. Now, again, I know that's a lot of money, but 5% is that much more equity that you have in your house. And even though I see this market flying, even though it's been consistent for the last 20 years or more, I'm always looking at the downside. I can't help myself because I've seen the downside. I'm old enough to know multiple downsides. And so I know things can change. I know that the more equity that you have, the better position you're in. So think about that. We still have 20% down rates. There's still a reason to buy 20% down. And I'm going to deal with that in the next video to tell you how I'm changing the calculations. Well, I'm not changing the calculations, but I'm changing certain importances that I'm going to give to, or importance I should say, it's not good English, to appreciation over cash flow. They're still both there, but we're going to explain how these adjustments work and what the return on investment looks like.